Alright guys, so let's do an economic update today. And yeah, the moment I bring out the CP cup, it means I don't really care anymore. Things are just getting out of hand. And today we have to dive deeper into the trade war situation. So the US has revealed their game plan to punish the world. And this will have devastating effects on the world economy, especially Europe. But will it really destroy China's economy as predicted by everyone? But let's start off first with the financial casualty of the trade tensions, the big one. And we mentioned a few weeks ago how the euro is facing big pressures, and sure enough, the collapse it's getting worse. In less than 6 months, the EU currency has fallen by almost 8%, and it's very likely will hit parity once again. The same situation in 2022 is repeating where 1 euro will be equivalent to 1 US dollar. Now, just like how a stronger dollar is wrecking the British pound, it is revealing the underlying weakness of the euro, which is only going to make the recovery that much harder. Now, the big winners are, of course, the hedge funds, Wall Street. They are predicting doom and gloom for the euro. Now, the amount of contracts shorting the euro is tremendous. Over 60,000 contracts slamming the currency, the most bearish sentiment since 2021. Now, they're even betting for the euro to collapse under parity. Wall Street is hammering down the currency, and it's a big reason why it's probably going to go even lower. But while hedge fund managers they get their big bonus and they go out there and buy a new Ferrari, this is going to grind down EU's economy. It would also compromise their geostrategic position in the world. Now, when the currency drops, it creates two daily effects. Firstly, and the most obvious, is local inflation is going to rise. And this is coming at a very bad time where deindustrialization is already happening. Now, we know the EU is suffering from higher energy prices. A weak euro jacks this input up. But that's not all. Unlike China and the US, Europe as a whole is devoid of raw materials. They don't have the metals, they don't have the rare earths, or even the refining capacity to make their own industrial inputs. Their supply chains are weak to non existent, especially compared to the two big superpowers. Europe imports a ton of intermediate goods. 60% of all imports fall into this category. And these are the raw materials like steel and wood and lumber. Industries need all these inputs to create the finished product. Now, the block of steel is the intermediate good, while a car is the finished good. So that's the difference here. However, the situation is actually worse. Nearly 17% of all imports are capital goods, and these are the machinery, the equipment, and the tools needed to create the end product. So almost 80% of EU industrial inputs they are imported in. So a weakening currency is bad for Europe's industries. The cost of production and exports would rise as well. Now, this is the direct effect of the dollar wrecking ball. We have said it many times. It reveals the underlying weakness of global economies. Because Europe has cut themselves away from cheap Russian gas and they're putting up some trade barriers to China, it becomes a double whammy. It's not a surprise that Mario Draghi he's in panic mode. He's warning that the EU will lag behind the US and China. I mean, Captain Obvious, right? But unlike these economies, Europe can't afford to decouple from the world, which makes it very likely that we'll move towards two eventual outcomes. Either more industrial companies will leave Europe, or the politicians, they'll just throw in the towel and they'll restore cheap energy. They could even fire back the nuclear power plants as a last resort. Now, the situation is looking really dire. The US is about to launch a global trade war, and China's stimulus won't really benefit the EU. It is to boost their local consumption of local Chinese goods. Europe's biggest trading partners, well, they are looking after themselves. Now, a big drag on the euro is about to get worse as well, and it's thanks to US bond yields staying high. Thanks to Washington borrowing a ton of money, investors they are demanding a higher return to hold US debt. As a result, the average 10-year yield has risen from 2.4% to over 4%. Even BlackRock is predicting this to reach a 5% handle in the years to come. This is not good news for the euro. As the dollar rises further and US yields they stay stubbornly high, this is going to drain capital from EU assets. If investors withdraw money from EU debt to buy US bonds, demand for the euro is going to drop further. And now you know why hedge funds they are betting against the currency. They realize that Europe is trapped and Trump's tariff war is only going to squeeze the G7 further. The inflation nightmare isn't over just yet. Now, this chart shows us the biggest exporters in 2023. China, the US, and Germany, they are the big three. But something tells me the red portion, which is Asia, is going to grow because the majority has access to cheap energy and supply chains. The advantage is with them. Global exports is a zero-sum game. Now, whatever production capacity the EU loses will be transferred to countries like China, Vietnam, and Thailand, just to name a few. There's also another problem. Now, the euro has always been a very troublesome issue. 20 EU member states, they use it as the official currency. But their economies are extremely different. The Germans are very different from the Greeks. The Spanish economy isn't identical to France. Having one set of monetary policy is going to cause even more problems for the EU. It gives Brussels a tight grip over interest rates and the fate of member economies. Now, back in 2022, the Commission froze 22 billion euros earmarked for Hungary over internal disputes, and that was a big economic blow to Orban. This amount is around 9 to 10% of the country's GDP. It is very significant. So the EU has a lot of internal problems and is starting to show. To maintain the strength of the euro, there are only a few options left. And no, raising interest rates isn't possible for the ECB today. It will just crush economic growth. Unlike the US, Europe doesn't have the capacity to borrow endless amounts of money. The next best way is to export their way out of a crisis, but even this door is starting to close shut. The biggest threat to exports today is Trump's tariff war, and we have a new frightening update on that front. The incoming administration has reviewed their plan for the world. Trump's team could boost import tariffs by 2 to 5% a month on their global trading partners, not just China. It could extend to Canada, Mexico, and the EU, and virtually any country that Trump wants. And this can be done by using the Emergency Economic Powers Act. So it likely doesn't even need congressional approval. And let's do a quick recap here. Trump wants to impose a minimum tariff of 10 to 20% on all imported goods. So maple syrup from Canada and cars from Germany could get clobbered. Now, 60% tariff would also be applied specifically to China. So yes, Chinese exports to the US could fall much harder than their G7 allies. However, there is a growing difference between Beijing's economy and Europe. The EU is horribly dependent on the G7 themselves to sell their exports, especially the United States, and these economies are not growing as fast as the global majority, especially BRICS. In July last year, the EU exported 47 billion euros worth of goods to the US, so it's easily half a trillion dollars of income from the United States. A 10 to 20% tariff would definitely decrease the amount of exports. If Trump wants to punish the EU, he could send companies out of business. His trade war could also send the euro spiraling down to new lows.
But the worst part is Europe to us on trade is horrible. They don't take our farm products. They don't take our cars. I said to Angela Merkel, Angela, how many Chevrolets do you have in the middle of Germany? She said, none. I said, that's right. They take advantage of us on trade, not quite like China, but not that far off. We lose $250 billion a year with Europe trading with Europe, but they screw us on trade. So they screw us on trade, and we're defending them. It's always a one-way street. You know, when I came in,
I mean, you just heard it right. Trump isn't happy with trade with the EU or spending money to defend NATO for that matter. So in 2025, Europe is about to face a world of trouble. They will need to find new markets to sell their products to, but that once again boils down to the debate of quality and price. Can the EU reduce their cost of production? And that is just assuming their quality is top tier standard. Because to sell goods to the rest of the world, you'll be competing a lot on pricing. You'll be facing the Chinese industrial machine. Now, Beijing, on the other hand, is already starting to decouple from US trade. They are building new markets to sell into, and that's a big part of their Belt and Road plan, and it's working. China's foreign trade with the BRICS and partner countries increased by 5.5%. Total trade reached a new record in 2024, coming in at nearly $6 trillion worth. So would Trump's tariff hurt China in the short term? Yes, revenues could come collapsing down, but that's just the short term. Would it collapse the Chinese economy? No, it won't. The process of decoupling, well, yes, begun a long time ago. In fact, the Trump tariffs are giving Chinese exports a tailwind. American companies are starting to stockpile a ton of Chinese goods right before the trade war. China's trade surplus has soared to $1 trillion ahead of Trump's return. A big part of this is US companies front loading their demand. They are scrambling to buy cheap goods before the tariffs hit. But look carefully at the real growth driver, it's Southeast Asia in blue. Since 2013, demand they have been trending higher and higher. Even demand from the EU is staying strong. So it's premature to conclude that China's exports or the economy will collapse. And we aren't even talking about Beijing's upcoming stimulus yet. That alone could be another game changer. But let's stick with the story of exports. In 2025, we could actually see the EU buy more goods from China thanks to the collapsing euro. And it's because of their own economic survival. The EU's reliance on Chinese imports have been growing. You can see the big jump from 2017 to 2023. Imports from China have increased from around 22 to over 25%, increasing by 3 percentage points. And why is this the case? Isn't Europe supposed to decouple from the Chinese economy? And the answer is quite simple here. They can't. As the euro drops lower, EU companies need to source for the lower price inputs. The raw materials going into the industries has to be the most affordable. They aren't buying those from the US. Some are coming from Asia, a portion from Africa for sure. But the big increase tells us the truth. The EU is relying more and more on Chinese supply chains. So, in a weird way, Trump's tariffs on Europe could create big unintended consequences. EU imports from Beijing could increase instead. And here's what we mean. This is the list of the 10 contributors to China's increase in exports to the EU. And let's go down the list. We have EV batteries, electric vehicles, solar panels, chemicals, and machineries, the majority of which are input materials needed for EU industries. Sure, Europe can choose to decouple from Chinese supply chains, but do they have trillions of dollars to build their own? And if they don't lower their manufacturing costs, even selling to the US will be harder thanks to the tariffs. This is an example of how Trump's tariffs could just backfire. It's a big possibility. Just like the sanctions on Russian oil, the world will find a way to get cheap oil and gas from Putin. And in this case, the global economy will rearrange itself to acquire cheap goods from China. You can bet on that. The tariff war might help reshore US manufacturing. 100% that could happen. But it could even make China stronger long term. But let me know what you think. Can the EU save their currency? Will Trump's trade war crush China or benefit it instead? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.